Live from the City of London for our audience worldwide, with equities on a back foot, down 0.4% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
"30 minutes away from the opening bell." Coming up on the program, chipmaker Intel delivers one of its gloomiest outlooks ever. Republicans discuss kicking the debt ceiling can down the road, and looking ahead to Fed Chair Jay Powell taking center stage. We begin with the big issue: the cracks in tech get bigger.
For the big tech stocks,
big tech
earnings.
There will be winners and losers.
Microsoft is talking about a weak global backdrop.
Intel is in a very, very difficult position.
Tesla has no demand issue, but part of the plan is to keep taking prices down.
The cost cuts can only get you so far.
The message we're getting from this particular sector is that growth is slowing.
Some of the tech names, have become a lot cheaper than they were.
We're continuing this process of reevaluating valuations.
But I'm not sure that that's going to continue.
Let's not break out the champagne glasses at this point.
There's a lot of work to be done.
It's all the other companies that have yet to report.
Let's start the conversation. Joining us now, Morgan Stanley's Lisa Shallett, Peter Cicchini of Exonic Capital. Lisa, first to you. I'm looking at Intel, dreadful forecast. I'm looking at Microsoft this week, deceleration ahead. Are you hearing exactly what you expected to hear from these tech firms?
Actually, I think it's a little bit worse, but it's directionally confirmatory, Jonathan, with, I think, where the folks at Morgan Stanley have been, which is that there's definitive risk to the earnings profile as both pricing power and volumes decline, coming off what has been a historic stimulus over the last 2.5 years, and a pull forward in demand. We used to say, that, what happens to GM happens to the U.S. economy. I would say we're in a world, given the ubiquity of semiconductors, that what happens to Intel happens to the economy.
Well, Intel's getting battered right now, and we'll talk about it in just a moment. Your words, Pete, I want to use your words. In the first 3 weeks of January, equity markets have already rallied. How much more delusional can they become? Can you answer your own question?
Well, it's the hardest question to answer. There's one of the most massive disconnects I've seen in my career between bond markets and equity markets at the moment. We have a deeply, deeply inverted yield curve, which I don't think is emblematic of a dovish pivot. Rather, it's emblematic of a recessionary environment, which just about across the board, early earnings reports have been showing, from Sherwin-Williams to Microsoft to Intel. And the equity market has been ignoring it, I think largely because of early year flows, but also because a handful of tech names tend to dominate, the NASDAQ and the S&P. We all know who those are: Tesla, Apple. And I think that's likely to change, I would say, perhaps over the next month or so.
Well, look at these year-to-date moves already. The S&P up 5.75% year-to-date. The CSI 300 over in China year-to-date up 8%. The Euro Stoxx 50, everyone's seemingly on board year-to-date, up almost 10%. The outperformance comes from the NASDAQ 100, up by more than 10 full percentage points. Now, Lisa, I want to bring you on this. You can learn something from the incoming information, and you can learn something from the way the market responds to that data. What are we learning in terms of the market response?
Well, we're learning right now, to the points that have been made, is this is a investor driven market where folks want to view the glass as half full. They want to look through the bad news and hope for better days. And their view is, the hope for better days is that somehow, the Fed is going to miraculously start cutting sometime soon, and that's going to be the panacea for everything. We are in the camp, as you know, that suggests that is a little bit too much wishful thinking, and that a lot of what's really gone on here in the first 4 weeks of the year is much more emblematic of flows. We have seen since October a massive global easing of U.S. dollar liquidity. How often do you see commodity prices round trip at the same time that the US dollar is down 11%, at the same time that the United States Treasury stops issuing and sucking liquidity in, at the same time that the Bank of Japan is contemplating the end to yield curve control and the end to their bond buying program? How often does that happen? Never. And so we have seen this easing of financial conditions that is spectacular. It's flying in the face of what the Fed is trying to do. And I think it's all money flows that are driving this market right here.
Pete, I want to give you the opportunity to weigh in on this as well. Why isn't the weakness of last year just last year's story in tech? Haven't we priced in enough of a weakness into this sector already? And what are we seeing on the screen right now? Why isn't that a challenge to your view?
Yeah, no, I think not. I think the repricing of risk assets last year came primarily from the rate shock and the adjustment that had to happen to PEs. And this year, really, and we're in the midst of this odd, awkward transition from market participants sort of absorbing the impacts of the new rate regime and transitioning to this idea that the real economy and earnings are really the next catalyst for the leg lower in equities and high yield bonds as well, corporate bonds, in our opinion, this year. So that transition takes time because there's a lot of exhaustion relative to the bearish view at the moment. So I think it's partly that. But that transition from a sentiment standpoint, I think, is taking some time. But at some point, bad news will become bad news rather than something else. And I guess lastly, I'd say the Fed has been very clear. In its last statement, it said there was an unwarranted easing of financial conditions. I think that makes it pretty clear that the Fed does not want to see equities back at 4,400 on the S&P.
Well, they're down this morning. 24 minutes away from the opening bow. We're down 1/3 of 1% on the S&P. On the Nasdaq, we're down 1/2 of 1%. Intel down a whole lot more. Kaylee Lyons has the story. Hey, Kaylee.
Hey, John. Yeah, no surprise. Intel is down now about 9% before the opening bell after what was frankly just a really, really bad forecast. One analyst over at Bernstein called it astonishingly bad. They are actually forecasting a loss for the current period of about 15 cents a share. Analysts were expecting a profit of 25 cents. Plus, when you look at the range of the revenue guidance at the low end, it missed by billions and billions of dollars at $10.5 billion, which would be the lowest total revenue for any quarter going back to 2010. So this is just really grim, and it speaks to the downturn specifically in demand for PC chips, which is Intel's main business. And it's a signal that slump is likely to continue this year. That's weighing on fellow chip makers like NVIDIA and AMD. They're down about 1.5% and 3.4% respectively in pre-market. And then KLA Corp, which gave its own disappointing forecast today, is down by about 4.4%. This is in keeping with the other misses and punishments we have seen in the chip sector so far. Wolfspeed fell about 6% after giving weak guidance yesterday. We saw punishments for Texas Instruments and Micron as well. And even one of the outliers here, Lam Research, which actually rose yesterday after its results, the forecast was still weak. Perhaps you can attribute that gain to the fact that they are cutting 7% of its workforce. And that's probably a saving grace considering we have seen investors reacting positively to job cut announcements in the tech sector. And we know, John, there has been a lot of those, many of them coming from the mega caps themselves, more of which will be reporting next week. Meta is reporting on Wednesday. We're expected to see a revenue decline of about 6%. Then Amazon, Apple and Alphabet on Thursday. Just those four companies together representing roughly $5 trillion in market capitalization, which of course is a whole lot less than they used to be collectively worse. And we're going to get more insight, John, into how the slowdown in the economy is affecting the revenue growth of these once, and I stress once, super high growing companies.
A massive week of results coming up next week. Looking forward to your coverage of it, Kaylee. Thank you. Intel getting absolutely slammed going into the opening bell. Here's the take from Barclays. This is an interesting one. They say this: Q4 results confirm what everyone seemed to have expected: slowing demand, margins pressure, and uncertain outlook for 23. But they're not a shocker either. They go on to say the Fed and ECB meetings next week may matter more for the near-term fate of the equity rally than earnings. That from Barclays. Lisa, you say it's best to lose the obsession with the Fed. So what would you say back to that note from Barclays this morning?
Look, I think, given the rally and given my comments on financial conditions, I do think that next week's meeting does take on significant importance. I am in the camp that says, that Chair Powell is going to push back aggressively around this bullish narrative or this idea that they're going to cut anytime soon. I agree with the points that have been made. I do not think that this easing of global financial U.S. dollar liquidity conditions is what he wants to see at this point in the cycle. And I think it's going to keep them leaning hawkish.
Pete, why aren't actions louder than words? This is another downshift. Most people expect 25. Why aren't actions louder than words?
Yeah, if the Fed really wanted to accomplish what it says it wants to, it would do 50 in the upcoming meeting. I do think this is a pivotal meeting. I don't think they will do 50. I don't think they have that kind of resolve, mostly for that reason. But I also think they're cognizant of the fact that policy does work with long and variable lags, and there has been an extreme tightening of financial conditions, one of the most aggressive in history since the 1970s, and in response to some of the worst inflation we've seen since then before. So it's certainly warranted. But, it is prudent to slow the pace of hikes. What I think investors are missing is this long and variable lag effect. The economy is going to start to feel it this year. We're seeing it in the layoffs that are being announced. And the Fed is not going to react the way it normally does. I think they're misassessing where the Fed put is struck right now. It is not struck down 20% on the S&P 500 because of inflation, in our view. And I think that's what's being missed here primarily.
Lisa, the focus on the data makes sense, focus on the fundamentals. I hear that from you. But then I look at the fundamentals yesterday and saw claims at 186,000 and saw the way the bond market responded to it. Sure, yields were higher, but not materially so. Lisa, why do you think that is? Why is this market not responding to the way you think it should respond to the data?
I think we alluded to it. There's a lot of look through. There's a lot of ideas that somehow we're approaching a trough. And I was on a call this morning with someone, who was telling me, on the Microsoft earnings, hey, this is as bad as it gets. And, we were kind of pushing back and saying, wait a minute, we're getting these fourth quarter results against a backdrop where, fourth quarter U.S. GDP was just reported at 2.9% real, right, with inflation that we know is still running, between 5 and 6. So we're talking about, an economy that could be, nominally growing at 8. And this is what these companies are doing at 8. What are they going to do when we may get down, to 2 or 3? So, this look through this, the glass is half full attitude, again, I think is being emboldened by liquidity and this sense that there is less liquidity pressure in markets.
Lisa, I think there's also a feeling that if you took a 12-month rolling view of the economy, that outlook over the last few months has improved. It's got better, not worse. Would you push back against that?
I think on the margin, it has gotten better, but it's gotten better for a lot of reasons, as we talked about, that are somewhat luck, right? I'm not sure that the European, view has materially improved because of fundamentals. I think, we got an incredibly warm winter, which has taken the boil off of some of the inflation issues. And we've gotten a, announcement of, potentially more aggressive stimulus coming out of China, which, folks have been talking about, for at least 6 months. So I'm skeptical of that view, right here.
Pete, can I come to you on the same question and just finish there? If you took a 12-month rolling view of the economy, has it got better or worse over the last few months?
Yeah, I would really echo Lisa's points. I don't think it actually has gotten better. But to the point about fortuity, oil prices have made a big difference. And there are a lot of reasons for that. China was slower to reopen. There was another month worth of SPR draw without replenishment. And energy prices make a lot of difference to the inflation story. And oil is creeping up and not going down, especially given the geopolitical backdrop and the layoffs that we're seeing this earnings season. I don't know how that can be ignored. Those are going to creep through quickly to claims over the next few months.
We'll talk about that in just a moment. Peter Cicchini, Lisa Shallett, sticking with us. Equity futures right now down 0.4 on the S&P, on the Nasdaq, which has been absolutely flying year to date and over the last week too. We're down a little bit, a bit softer, down 5 or 0.6%. Coming up, another player entering the debt ceiling debate.
The very notion that we would default on the safest, most respected debt in the world is mind-boggling. I will not let anyone use the full faith and credit of the United States as a bargaining chip.
That conversation up next.
The very notion that we would default on the safest, most respected debt in the world is mind-boggling. Look, if Republicans want to work together on real solutions and continue to grow manufacturing jobs, build the strongest economy in the world, and make sure Americans are paid a fair wage, I'm ready. But I will not let anyone use the full faith and credit of the United States as a bargaining chip. The United States of America, we pay our debts.
The President of the United States slamming the GOP, House Speaker McCarthy calling him to the table, tweeting the following, quote, "If the President is so eager to speak, then he should set a date to discuss a responsible debt ceiling increase." This is signs that Republicans could kick the can down the road. Bloomberg's Anne-Marie joins us right now to discuss. AMH, let's talk about that right now. What are the chances this can happen?
Well, we don't know yet, right, Jonathan, because this is just a proposal right now within the Republican Party, according to people we're speaking to. But we're not sure yet if Democrats would go on board with this in Congress, whether even the White House would go on board with this. So basically, and Chris Kruger of Cohen actually outlined it. He said, build more land. That's an option. Kick the can down the road. But the issue is in Washington, the can always comes back and you have to deal with it. But what this would do was just put off the risk of default until September 30th. For the Republicans, this could be a good negotiating tool because that would then align the debt ceiling talks specifically with funding the government, because appropriation bills, Jonathan, run out at the end of that month as well.
So, Anne-Marie, what kind of date are we talking about? I'm still trying to figure out this X date. Where is it on the calendar?
Well, it's interesting because you can't exactly place it from where we sitting are today in February to where it's going to be. When you talk to the likes of Mark Zandi, though, it's somewhere in the summer. So likely sometime at the end of the summer. So really the talks are going to get very heated in June, and then that's going to last until August, unless they do kick the can down the road, and then it goes to the end of September.
AMH, thank you. The latest down in DC. Now, every time I ask a guest about this topic, I get a shrug of the shoulders, and here we go again. Lisa Shallett, Peter Cicchini, back with us to shrug their shoulders and say, here we go again. Peter Cicchini, is that how you feel about this issue?
Yeah, I think my response to you was ho-hum. Been through this. It's really unfortunate that the fiscal condition of our country is used by politicians in the way it is. Unfortunately, we are simply spending too much, but modern monetary theory has made it, frankly, acceptable in a lot of schools of thought. Perhaps now that we've seen this broader inflation, which was partially at least brought on by the deficit spending from the pandemic, politicians will be a little bit less hesitant to be profligate. But it will be resolved. It will take time. To the president's point, no one wants to be responsible for default. And unfortunately, that's one of the reasons why we go through this on such a regular basis.
Lisa, do you agree?
100%. I mean, this is pure politics, plain and simple. There is extraordinarily low odds that ultimately Treasury wouldn't find a way to pay all its debts and all its constituents. This is money that has already been appropriated by Congress, as has been discussed. And so, this is pure politics, and it is quite unfortunate because it just creates unbelievable amounts of uncertainty. And the other thing that it does is it really, pushes around Treasury strategy around their issuance, which again impacts market liquidity. So it's just unfortunate. It's another source of volatility for investors that, might have been avoided.
Yields this morning just a little bit higher on Treasuries. Not a big deal, that's for sure. I want to finish on this. You're both pretty bearish, so let's finish with a part of the market that you do actually like right now. Lisa Shallett, where is that part of the market at the moment?
So, we're looking at some of the deep cyclicals that have sold off. So we've started to get some moderation in some of the housing data. So we're looking at some of the home builders, some of the residential REITs. We do like some of the semiconductors down here that look like they're starting to put in cyclical troughs in the traditional sense. Some of the software services companies look interesting to us. So we would be there. Financials, healthcare, energy, industrials. We're finding stocks to pick here.
Peter, you get the final word.
Yeah, look, we're largely a structured credit firm, and so we're seeing opportunities in structured credit with high single-digit yields on over-collateralized bonds, and we love that, especially versus corporate credit or equities. And when you think about where equity risk premium is, if you look at a 5% earnings yield on the S&P 500 versus 4 and change on the 2-year, there's no equity risk premium. So it's clearly not in equities. Collateralized cash flowing structured credit for us is really the place to be right now.
Pete, great to catch up, as always, alongside Lisa Shallett, going into the weekend and looking ahead to a massive week ahead with central banks on deck, the Federal Reserve, the ECB, and a ton of earnings as well. Coming up, the morning calls, and later, Intel forecasting one of the worst quarters in its history. We're looking ahead to a busy week of tech results with RBC's Amy Wu-Silverman. Intel down 9.5%, equity futures down 0.4%, and the Nasdaq 100 softer by about 0.6% year to date. Absolutely flying. Your opening bell, 7 minutes away. 5 minutes away from the opening bell. Equities down just a little bit by 1/3 on the S&P. On the Nasdaq right now, down 0.5%. Let's get you some morning calls. First up, UBS upgrading General Mills to buy. $88 price target, highlighting the company's consistent free cash flow and improving balance sheet. That stock up by 0.9. Next up, BMO downgrading Ralph Lauren to underperform, seeing limited upside with margins under pressure. That stock is down 3.4%. And finally, Argus upgrading Las Vegas Sands to buy. $68 price target, expecting the company to benefit from the end of China's strict COVID rules. We're positive there by about 0.5%. Coming up on the programme, RBC's Amy Wu-Silverman seeing demand for downside protection ahead of a monster week of big tech results. That conversation just around the corner. Futures negative 0.3%. We are about 22 seconds away from the opening bell. Let's get you some price action briefly in the equity market. Equities right now down 1/3% on the S&P. On the Nasdaq, which has been absolutely flying year to date and over the last week, was softer there, negative by 0.5%. The opening bell in New York City rings. Switch up the board and get to the bond market. Yields look like this going into a pivotal week potentially for the Federal Reserve. Going into that, yields just a little bit higher, up 5 basis points on a 10-year to 354.22. Dollar showing some strength, euro some weakness. Euro dollar down 0.4%, a break of 109 again at 108.50. And looking elsewhere at what's happening with crude, WTI $82 and about 15 cents, positive there 1.4%. We are about 20 seconds into this. Equities are lower by 0.25% on the S&P. On the Nasdaq down by 1/3%. One stock to watch at the open. It's Intel getting absolutely hammered. The chip maker reporting misses across the board and issuing a pretty grim outlook. The CEO saying this: given the continued uncertainty, we expect PC consumption to be on the lower end of our estimates this year. That stock hammered on the West Coast. Here's Ed Ludlow.
Good morning, Jonathan. The stock down 10%, a significant drop. And what was so interesting in the sell side response is that even against extremely low expectations for the first quarter forecast, this was a surprise and an astonishing forecast from Intel. Let's get straight into the numbers. A forecast for adjusted sales, $10.5 billion to $11.5 billion in the first quarter. But even at the top end of that range, you're still $2.5 billion below the consensus estimate. A surprise forecast for an adjusted loss of 15 cents a share The street was looking for modest EPS of 25 cents, but we point out in the Bloomberg story that on an adjusted basis, at least, this is the first prediction of a loss in a quarter that Intel has made in decades. The story in its end markets, Jonathan, is very clear. Look at PC and desktop demand. Look at data center. Both account for almost 80% of revenue, both dropping year on year more than 30% in terms of that quarterly revenue change year on year. The message from management is bear with us. Of course it is. Look at how Intel shares have performed since 2021 when Pat Gelsinger returned to the company and took over as CEO. At that time, it was the top chip stock. It's lost its crown since then to Nvidia, but they look like there are no signs of that ever coming back. And Gelsinger on the call, John, made a pretty clear point. I'd like to remind everyone that we're on this multi-year journey. We're more than a year into the multi-year journey. I guess the question for the street is how much patience have you got for that journey?
Maybe not much based on this morning's price action. Ed, thank you for that. Intel down by 10 percentage points. We've seen some bad tech earnings so far this earnings season, but tech, the NASDAQ, if that's how you capture tech, has performed tremendously well. We are only down about 0.2% right now, and year to date we're up about 10 full percentage points. Michael Hartnett over at Bank of America published this morning. Here's a quote for you. This year tech has been playing catch up, rate cuts, dollar down, job cuts for margin. Speculation has returned. He calls it the pain trade. The pain trade has been higher to 4.1 to 4.2K on the S&P 500. Right now 40.53 on the S&P. He goes on to say, after that, after you get through 4,200, after that we sell, as we now are close to the moment where stock gains start dragging yields higher. That from Hartnett this morning, something to think about anyway. Here's another name for you, Amex, painting a very different picture to Intel. The firm forecasting a surge in revenue after record card spending. The CEO saying it's, quote, in an even stronger position today than before the pandemic. This as competitors saw slower than expected spending in the last quarter. Let's get to Abby for more. Hey, Abby.
Hey, John. Yeah, this is an interesting one. And as you mentioned, the stock is surging its best day in about a year. This after that record spending last year. Now, interestingly, the quarter that was a little bit messy on the surface, but that outlook, it's all about the outlook. The fact that consumers are spending so much, the idea that they were able to boost their ranges for pretty much all metrics in a big way. Relative to earnings, they're looking at a range of $11 to $11.40 for this year versus the estimate of $10.43. They're looking for revenues to rise 15 to 17% versus the 11% growth estimate. So really all systems a go. Now, it has to do with that consumer spending. It's really interesting because during the pandemic, at the beginning of the pandemic, we saw credit card spending really plunge to less than $1 trillion. Now we're at a record high, closer to $1.2 trillion. It seems as though with the inflationary picture, some folks have also been using credit cards for essential needs, not just the nice to haves. Now, relative to the recent rally, we have the credit card company stocks doing really quite well, up as much as 11% into the open. I'm guessing that American Express up much more. There you go. Well, up right about 11%, taking that spike, outperforming the financials overall. Now, American Express, John, is a part of the financials, but Visa and MasterCard, those stocks up close to about 10%. They are actually a part of the technology group. So there's another piece of that tech rally that we can't get away from this year.
Abby, thank you. Amex up by 7.4% this morning. Abby, thanks for that. Chevron is down by 2.75%. It's a miss for the oil major. Disappointing fourth quarter results coming just days after announcing a monster buyback program. Here's Katie Lyons with more. Hey, Katie.
Yeah, so John, this loss of nearly 3% at the opening bell this morning is giving back some of the gains that were made yesterday when the stock rallied nearly 5% after that $75 billion buyback announcement. So a little bit of that optimism from Thursday is not filtering through to this Friday on that disappointment. Revenue did come in ahead of expectations, but net income came in light and profit of $4.09 a share fell short of the estimate. Now, part of that is just the fact that oil prices have come down, but another part, too, according to analysts over at RBC Capital Markets, and we'll have to excuse the fire alarm going off here in the U.S. John, hopefully you're not hearing that in London, but you have corporate costs as a factor here, and the outlook came in light as well. I would just note, and I'm going to wrap it up because this is really loud over here, Chevron did have a record year of profit in 2022, and we know, of course, that has drawn political ire. They would like to see them investing more in output, not buybacks, but we know Chevron is trying to do both, John.
I'm hoping this is a drill, but you should probably run. Kaylee Lyons, thank you. Only Kaylee could remain that calm in the face of a fire alarm going off. I assume that's a drill, and hopefully for Kaylee's safety, it is one, and I'll confirm it is one in a couple of minutes' time. Equities right now down 0.2% on the S&P 500. We are about 6 minutes into the session. The Nasdaq is negative by 0.15%. RBC's Amy Wu-Silverman seeing a shift in investor behaviour and writing the following: we came into 2023 underhedged, underinvested. We're starting to see this change somewhat, seeing renewed demand for downside protection. Amy, I'm pleased to say, joins us right now. Amy, great to catch up with you. You said in your notes that you've published recently that this is the boy that cried wolf market. Can you tell us all what you mean by that?
Sure. Good morning. So, look, when you look to last year, the S&P drew down 20%. And the only option strategy that did worse was if you owned the S&P and owned puts, you managed to be down 21%. So, it was pretty unlucky for investors who wanted to hedge, got the drawdown, and still managed to lose more money. And so people were burned. They didn't want to listen to any of the metrics coming up. And I think that's why we ended up in 2023 with the positioning that we saw. So I find it very interesting now, John, that we are finally starting to see this uptick in demand for downside protection that we didn't see at all during the drawdown last quarter. And we finally started to see that change.
So, Amy, you're saying investors are using this recent strength to reload on downside protection. And if they are, what are you advocating they should do?
Yeah, I would say two things. One more sanguine interpretation is that part of the reason we finally see this demand, John, is because people are actually becoming more invested in the market. So, there's only something to hedge when you've actually managed to make that money. The second thing I would say, as you start to get that uptick in skew, the options curve starts to structure in such a way that things like put spreads, which you and I have talked about before, look attractive based on their payouts. So, ahead of what is quite a monster week, both individually for stocks as well as for macro, and a VIX kind of sub 20, I think those trades look attractive.
Amy, can we talk about next week just quickly? How much of a risk event do you think that Fed decision actually is?
So, I think it's interesting because with PCE coming out as it did today, maybe that takes some relief into the market. But, to me, more importantly than even what the Fed will say is just the slew of tech earnings we're going to get. Because, if you continue to look at what the meat is made out of in the S&P and other ETFs, it's still, a handful of names, a handful of mega cap tech names. And sure, there was shrinkage in 2022. But if you look at that contribution return, John, from last year of that 20% drawdown, it kind of came down to 80% being, again, 7 to 8 mega cap tech names.
The longer this goes on, the more it hurts. But this rally in mega cap tech and the Nasdaq has been rip-roaring year to date. Amy, what are you telling your clients about it?
Yeah, I think one thing to keep in mind, and I was watching that Intel print as well, is, historically options can kind of tell you what the implied move is on earnings, but usually options don't actually beat their implied moves. The realized move on earnings, they tends to be lower. This has been the opposite really during the pandemic period. So, one name I would point to is Meta, which if you look on an 8-quarter basis, which is what most people do, it kind of looks like a fair implied move to earnings. But on a 4-quarter basis, this is a stock that realizes an 18% move in either direction on earnings, and it's only pricing in a 10% move right now. What does that mean? I think you own all implied moves by owning options. So, that can be to the upside or downside based on how your portfolio is framed. But right now, actually owning options pays far more during earnings season than it has in many past earnings seasons.
So we've addressed Fed, we've addressed tech earnings. Can we address China just briefly? This is one of these issues, and you've published on this, and it's important to recognize it's one of these issues that actually provides us with upside risk. And Amy, I'm wondering how you're telling people how they should gain exposure and participate in the potential that upside risk really develops even further.
Yeah, it's interesting. I'll tell you one thing. This is an area where the options market was quite early. We saw folks buying upside in ASHR, Web, Baidu, FXI, months before the reopening. And every time I spoke to clients, they said, look, am I going to get burned? Is this premium going to zero because China hasn't reopened yet? Maybe, but I have to participate. One thing I'll say is that's inflecting. We're actually seeing defensive positioning now. But two, for people who still want participation to China, I would actually focus on cheaper ETFs, maybe an EEM or single name Chinese ETFs like a Baidu, where that relative volatility hasn't priced in as much as something sort of more obvious like a FXI.
Amy, do you think the range of outcomes in the China story are wider than people give it credit for?
I do, and I've spoken to some folks where, they were kind of long earlier, and now the inflection point has gone to more defensive. And, my question has been, what do you think is going to happen? It looks like, we're kind of full blast on reopening. And the risk people point to, the left tail risk is that if you look to the reopening that happened in the US or Canada, it wasn't linear, John. It wasn't like, okay, we reopened, the end. There were fits and starts. There were different variants that came up. There were kind of waves of lockdowns. And that's the concern right now, which is why I think, given how far we've run, some people are starting to get concerned.
We've run a long distance already, and I think we're only 3-4 weeks into this. Amy, this was wonderful as always. Amy with Silverman there, looking ahead to next week and beyond, in the case of China at least. We're about 12 minutes into the session. Equities are down by 0.2% on the S&P. On the Nasdaq, we're lower by 0.15%. That's the session. Year to date, equity markets have been absolutely flying, from the Nasdaq 100 all the way over to the Euro Stoxx 50, EM and China for that matter as well. Year to date, the numbers have been absolutely phenomenal. I mentioned Michael Hartnett of Bank of America, and when Michael publishes his weekly flow data note, he puts in there, heard on the street, and just a quote from a client or something like that. And this was the quote this week. I'll read it to you. Another 3 to 5% here will feel like bathing in lava if you're a bear. This is painful for a lot of people the last few weeks, that's for sure. Equities right now then 12 or 13 minutes in, we're down about 0.1%. Coming up, the Fed and ECB releasing decisions next week after striking a hawkish tone back in December.
We continue to anticipate that ongoing increases will be appropriate.
We judge that interest rates will still have to rise significantly at a steady pace.
That conversation up next.
The full effects of our rapid tightening so far are yet to be felt.
More needs to be done.
Ongoing increases will be appropriate.
Risks stem primarily from domestic factors.
Inflation.
Inflationary pressures.
Inflation remains well above our longer run goal.
The 2% inflation target.
I wouldn't see us considering rate cuts
for a period of time
until the committee is confident that inflation is moving down.
Interest rates will still have to rise significantly.
There are not rate cuts in the SEP for 2023.
That was the message in December. A recent deluge of economic data and better than expected data now setting the stage for both the Fed and ECB next week. Those rate decisions front-running the US payrolls report on Friday. Team coverage begins right now with Bloomberg's Mike McKee in New York and Guy Johnson over in London. First to you, Mike, your thoughts on this Federal Reserve next week and what we need to look for.
Well, I think the numbers that we got today, and excuse us, there's a bit of a fire alarm going on in the background here. Numbers we got today on inflation make it fairly certain the Fed can do 25 basis points. The PCE inflation numbers that they follow closely went down on a year-over-year basis. And so at this point, it looks like the Fed can do 25. The question is what happens when we get into January, and do those figures suggest the Fed has to start doing more again? But right now, it looks reasonably good.
Chaos in the New York studio, Mike McKee. I'm not sure if you've got a run to be in this fire drill either. Mike McKee there, over in New York. No one seems to have a clue. Guy Johnson with us here in London, where there are no fire alarms, guys. So we're good, I hope. The ECB, it took me by surprise in December just to see ECB President Christine Lagarde as hawkish as she was. I think the most hawkish you and I have ever seen her.
Yep, and it's continued. That's the message. It has continued through January. We heard it at Davos as well. The World Economic Forum message was very hawkish. The message coming consistently from most members of the ECB is that we will see a 50 basis point hike at the next meeting. There are a few exceptions. The real question, John, is not what happens at this meeting that's upcoming. It's the signalling for the next meeting and the meeting after that that I think everybody's going to be watching out for.
If the doves are trying to be heard, I imagine there's some real division on that committee now.
Yeah, but the balance is firmly in favour of the hawks, and the doves are going to struggle. There was a long period of time when the hawks weren't heard. We've completely flipped that on its head now. There aren't that many doves out there either. Clearly, the Portuguese, the Spanish to a certain extent, the Italians, and the Greeks. But the amazing thing is that BTP spreads are being well behaved. And in some ways,
I'm surprised.
I think a lot of people are, and that is in some ways giving the green light to the ECB to do more. The market is signalling that it's comfortable with what is being priced in right now, and it opens up the possibility of further signalling as well when it comes to QT.
I keep saying this, you know, I was shocked that we managed to get to 250 at the ECB without absolute chaos in markets, and now people are talking up, what, 350?
Yeah,
more so?
I think that's being seen as being kind of where the market is. I think that is the expectation. Whether we get that far remains to be seen, because when things change, they change fairly quickly. We'll wait and see whether or not that ultimately is the destination. I do think, though, that while the destination is increasingly important, what we haven't had from the ECB is all of the details on QT, and I think that's kind of where I think the focus may become.
Let's talk about the destination for the year ahead for Europe. I've spent the week here, Guy. You've heard the same voices tell you the same things, which is that the ECB can hike more than the Federal Reserve this year, just in terms of the additional rate hikes. Maybe they don't get to 450. Who knows? I'm struck by the war in Ukraine still continues.
Yep.
I'm struck by the fact that it looks like it's escalating based on the fact that tanks are now going to be arriving in Ukraine in the next several months, and there's a conversation about maybe jets following. I have no idea where we are on that. I spoke to Amrita Sen earlier this morning of Energy Aspects about whether Europe could repeat the act that it managed to perform in the last 6 months, which was build up storage levels, build up capacity, build up gas storage, preparing for winter. Can they repeat the act for next winter? And she said she doubts it. No.
It's interesting because a lot of people do think that is now possible. They think that Europe is going to be coming out of this winter with significantly higher storage levels than is normally what would be seen. In some ways as well, it's about price. This is not a supply shock for Europe. It is a terms of trade shock. It is about how much you have to pay for the gas. And I think that is the critical difference here as well. It does come back down to China. What happens with China and its demand is going to be crucial in terms of what happens here. The weather, as we all know, is going to be critical. The big surprise this year has been around the weather. It's been Mother Nature that has provided the biggest surprise here.
Sure. Throw in a bit of coal as well.
Okay, throw in a bit of coal as well. That was already kind of there and ready to go. The fact that we've had to use it, maybe less than anticipated, I think is probably the bigger shock. And I think you've had a really interesting story this year. Can it be repeated next year? I don't know. Give me a long-range weather forecast and I'll probably be able to tell you.
Yeah, I'm not a meteorologist. I'm not sure a meteorologist is any good at that either.
No.
Guy, this was great. Am I seeing you in the States next week?
Yeah, I'm going to look forward to seeing you in the States. I've got to go via Seattle to the handover of the last 747
emotional.
on Tuesday.
Emotional.
Oh, yeah.
For you, not so emotional for me. Guy, I'm looking forward to the conversation, though. Great interview coming up next week. Look out for that. Guy Johnson's going to be with us stateside. I'll be there as well with Michael McKee, counting you down to that Fed decision. I can confirm that there wasn't a real fire. It was somewhat of a drill, if you want to call it that. OK, about 22 minutes into the session, equities positive now. On the S&P by a tenth, on the Nasdaq by a third. Let's get you some sector price action. Here's Abby.
Hey, John, and yes, much quieter here, although there was a moment where we wondered. At this point, we do have the S&P 500 up slightly, up almost about 0.2%. Most sectors are higher for the S&P 500, led by consumer discretionary, up about 1%. Communication services right behind. So we also have technology higher. Those mega cap packs once again leading the way. To the downside, we have energy, despite the fact that oil is higher, healthcare, utilities, and staples. So those defensive sectors, with the exception of energy, those are the ones on the downside. Now, we do also have stocks higher on the week. Surprise, surprise, up more than 2% relative to the sectors. Despite the fact that we have this Intel debacle, we actually have the stocks higher. We have the discretionary space higher on Tesla. To the downside, though, John, there are those defensive sectors. We really have investors going into growth quite strongly this year.
Abby, thank you. Up next on the programme, your trading diary. Equity markets turning around here about 25 minutes into the session with positive a tenth on the S&P and the Nasdaq up a third. Let's get you the trading diary. UMich sentiment survey coming up at the top of the hour. Looking ahead to a monster week, a Fed decision and Chair Powell news conference on Wednesday, followed by earnings from Meta, rate decisions from the ECB and BOE on Thursday, plus results from Apple, Google and Amazon. And finally, it's Jobs Day in America to round out the week. Here is your week on this program next week. What a monster lineup that the team has put together for you on Fed Day. Kathy Jones, Bob Michael, Chris Harvey, Mike Wilson. That's on Fed Decision Day. On Payrolls Friday, Mohamed Al-Arian, Rick Reeder, Anastasia Amoroso, Mike Collins. All of that coming up next week. Live from London, thank you very much for choosing Bloomberg TV. I'll be back with you in New York next week. This was the Countdown to the Open. Have a wonderful weekend. This is Bloomberg.